Hi, everyone. Joe Gentili from Sarraf Gentile LLP. Life insurance has the industry has evolved a lot over time. So a decade or a couple of decades ago, a generation ago, life insurance was primarily sold as a protection product that if you died, and you had life insurance, that life insurance would pay a sum of money to your beneficiaries in an immediate and tax-free way. And this was used a lot just to plan for income replacement if the breadwinner died, or for liquidity, that if you needed to divide an estate or you needed to pay for estate taxes. And the products that were sold were generally simpler products, and they were designed, and the strategies to use them were in a low risk or much lower risk way. So this is kind of a buyer beware video. So that's, I think, how most people conceptualize life insurance. I mean, life insurance is in the word. It's a safe asset to own. Over time, for a number of reasons, the industry has changed. So there used to be a lot of sales oriented, for instance, towards helping cover estate taxes, but now the estate tax exemptions are so high that that's not a common life insurance sale anymore, except for people that are pretty high net worth. And so agents have migrated to different ways to sell insurance. Probably the most common way that I see at least permanent life insurance being sold today is not to provide a death benefit, a permanent death benefit, but to provide a strategy to try to get income in retirement, tax advantaged income in retirement, and the death benefit is kind of this, nice add-on. It's the opposite from the way it used to be sold, where the death benefit was primarily where you're selling, and the cash value buildup was something that was great to have and useful, but it wasn't the main point. Now it's being sold in the reverse way. And as part of that retirement income strategy, they're also trying to market life insurance as having higher returns on that cash value. And so what we're seeing with that is, less whole life insurance sales, which are lots of guarantees in it, slow growth in cash value, to IUL, which I think is the fastest growing segment of the life insurance market, where cash values hypothetically could grow at a much faster pace because your money is being put into these indexes, which, if all goes well and the index goes great, you're going to get large returns on that. And so that's already a more risky product than whole life, because a lot of the guarantees in whole life are stripped away. And then you're hinging the crediting rate on the performance of an index. And then to add more risk to that, the indexes that you're hinging your performance to used to be the S&P 500 was the most common index. Now there's these proprietary engineered indexes that are all over the place, and that's where most money is heading towards. And so there's this another layer of complexity that's added to it, and those indexes frequently underperform. So that's another layer of complexity. And then you add another layer of complexity on that, which is that leverage is being applied, or at least people are being instructed to imply leverage, which just adds more risk, either through premium financing, where they're borrowing money from a bank to buy the life insurance, or we're seeing these strategies, and this is more targeted towards a mass market on social media, where you'd borrow money out of your life insurance policy only to buy more life insurance with it. So what started out as this very safe asset, protection-oriented sale has morphed into this income retirement planning strategies with ever increasing layers of risk on top of it. So the point of this video is buyer beware. Even though it's called life insurance, which sounds very safe, and it can be, there's a lot of strategies which are being used with products like IUL that are ratcheting up the risk on these to a very high degree, where it's easy to see scenarios where, if there's no leverage involved, you could end up paying premiums for years on these policies and end up with zero, no retirement income, or a lapsed policy with no death benefit. Or if we're adding premium finance onto that piece, if we're adding leverage on it, it could be even worse. So be very, very careful with what you're buying. If you're buying life insurance and you're buying it for the purposes of retirement income and you're doing it with an IUL, or especially if you're borrowing money to make this happen. Unfortunately, this is going to be an area, I think, where there's going to be a lot of litigation, and plaintiffs' lawyers like myself that are well versed in life insurance. This is going to be an area that's going to be keeping us busy for a long time to come, because a lot of people are buying these policies and they're being misled as to the risk that they're taking on by engaging in these transactions. So again, if you have any questions, please feel free to call, and I hope you subscribe to this video. Thank you. Have a great day.